3x3 grid that fixes how you think about investment risk. Everyone talks about risk the same way. What's your risk profile? Conservative, moderate, or aggressive? You answer 10 question form, get a label, and that label decides your entire portfolio. This way is broken because the truth is your risk profile shouldn't decide your portfolio. Your goal should. Risk profile just decides how you fund that goal. Stay with me. By the end of this video, you will have a simple 3x3 framework you can literally use to build your own portfolio this weekend. So what risk actually means? Most people think risk means, will I lose money? That's only half the story. There are actually two risks pulling in opposite directions. The risk of losing money, which is in the form of volatility, market crashes that really disturb you, and the risk of not having enough money when you need it because you played it too safe and inflation quietly ate your returns. If you only manage risk number one, you accidentally walk into risk number two. This is the single biggest mistake I see. People put their child's education fund, which they need in 15 years, into a fixed deposit just to be safe. That's not safe. That's slow motion shortfall. So the real question isn't, am I conservative or aggressive? The real question is, what is the specific pool of money for and when do I need it? That's where the second half of today's framework comes in. That is, we first understand the buckets. Instead of one big pile, you have three buckets based on what happens if this goal doesn't get funded. So the first bucket is the need bucket. This is the non-negotiable money, retirement income, your child's basic education, the house you live in. If this bucket fails, your life changes materially for the worse. Emotion attached to this bucket will be fear. You cannot afford to gamble it. Bucket number two is want. This is lifestyle money. A better car, a nicer home upgrade, a milestone family vacation, funding a child's post-graduation abroad instead of a local college. Nice to have, painful to miss, but life goes on. Emotion attached will be disappointment, but not disaster. The third bucket is aspiration. This is dream money, leaving a legacy for your child or children, starting a new venture, retiring at 45 instead of 60, buying that second home by the hills. If this bucket underperforms, honestly, nothing bad happens. You just don't reach the dream as fast, or you don't reach it at all. Emotion attached to this is excitement and not fear. So now here's the part almost nobody puts together properly. Every one of these three buckets can still be approached with a conservative, moderate, or aggressive risk profile. And that changes the portfolio completely. That is what I call a 3x3 grid. So let's understand what these profiles mean. Conservative doesn't mean scared of markets. It means low tolerance for seeing your numbers go down in the short term. Usually because you are closer to needing the money or because a big drop would genuinely hurt you emotionally or practically. Moderate means you can stomach normal markets up and down, but a severe prolonged fall would still worry you. And aggressive means you can watch a 30-40% drawdown, not touch the money and stay invested, either because of temperament or because you simply don't need this money for a long time. So the risk profile is about you, not about the goal. The bucket is about the goal. Multiply the two together. That's where the real decision is. So you combine your risk profile, which is you, and to your goal. So here's a 3x3 matrix. Let's go bucket by bucket. For each one, I'll give you a simple directional asset mix, not a precise recommendation for your situation. Just the shape of your portfolio so that you understand the logic. So the first row is the need bucket. The first box is the need and conservative investor box. This is the tightest combination. So it will be heavily a combination of debt and fixed income. So think of it like 75 to 80% of high quality debt, government bonds, PPF, EPF, all that will come under this. 15 to 20% will be large cap or index equity just to beat inflation. Priority of this bucket, or rather this box, will be protect the capital first and then growth. The second priority is growth. First priority is always capital protection. The second box is same non-negotiable goal, but the investor can handle some short-term swings. You can shift towards 50 to 65% debt, 35-45% equity, mostly large cap and flexi cap, still avoiding a high volatility categories. Now the third is need plus aggressive investor. Here's the nuance people miss. Even an aggressive investor should not run a need bucket aggressively if the goal is close. But if the need is far away, say retirement, which may be 25 years out, an aggressive investor can afford to have 60 to 70% equity even in a need bucket, because time itself becomes the safety net. The equity portion can include some mid cap, so you'll be allocating more towards debt as the goal gets closer. The next bucket is the want bucket. In this, the first box is want plus a conservative investor profile. Even though the goal is flexible, the investor's temperament still leads here. Roughly 55 to 65% debt, 35 to 45% equity. The conservative investor would rather delay the vacation upgrade by a year than watch a 20% drawdown. So we respect that even though the goal itself could absorb more risk. The next bucket is want plus moderate investor profile. This is what we call as a balanced profile. Roughly around 40 to 50% will be debt, and similar 50% to 60% would be equity. This would often be a diversified portfolio across large and flexi cap, some bit of small caps also as a satellite allocation, and investor could also think of thematic and mid caps also in this category. Because the goal isn't life crucial, you can let the moderate investors natural risk taking play out more freely in this bucket and this cell. The next box we have is want plus an aggressive investor profile. Now both the goal, the temperament, allow risk. 25 to 30% debt as a stabilizer, 70 to 75% equity, with real room for mid and small cap allocation. If the goal slips by a year because markets were down, it's a disappointment, not a disaster. So we let the aggressive investor run. The next row is aspiration bucket. The first box is aspiration plus a conservative investor profile. The goal itself has zero real downside if missed, but the investor's temperament still holds them back. Here, I'll nudge you gently. Since there's no real cost to failure, this is actually the ideal bucket to stretch your comfort zone a little. Still respect the person, maybe 50% debt, 50% equity, rather than going fully aggressive so they don't panic to sell. The next bucket is aspiration plus a moderate investor profile. This is where you let equity dominate. So 25% debt, 75% equity, meaningful allocation in mid and small cap, maybe even a satellite allocation to international equity or gold for asymmetry. And the last we have is the maximum risk cell, which is aspiration plus an aggressive investor profile. Pretty much all equity, almost 90% plus, and heavy tilt towards mid and small cap, satellite position in thematic, international, even alternate assets if the investor understands them. Debt allocation is almost just for liquidity. Debt allocation is almost just for liquidity, not for safety, maybe even being an opportunistic allocation. If the market falls, debt allocation will help to enter again, or rather average out. This bucket is where you let your conviction and time do the compounding. Now, in all the cells, I have taken equity which is the listed equity distribution. You can associate that with mutual funds or otherwise, but you can very well substitute in this particular segment, say, an aggressive and an aspiration bucket where even your startup investing would come in. And even the other buckets, you can think beyond just the typical equity allocation in the markets. You can very well think of private allocations. You can very well think of startup allocation or a VC fund or a PE fund, but that will all sit in the extreme segment, that is aspiration and an aggressive investor profile. So even if you are in aspiration, but if you're a conservative investor and the goal is far away, you may not want to enter into a private allocation, a PE fund or a VC fund, because the volatility will not help you get good sleep. I've given you a lot of grids, around 9 combinations, and I think it can be overwhelming. So here's a rule of number one. The need bucket is always debt heavy, no matter your risk profile, unless the goal itself is decade away. So don't let your personal aggressiveness override the fact that this money simply cannot fail. Rule number two is your risk profile matters most in want and aspiration buckets, not the need bucket. That's the biggest mental shift I want you to walk away with. Stop asking, am I aggressive, before you even know what the money is for. Ask, what is this money for first? Then bring in your temperament. Rule number three, if you only remember one line from this video, the need bucket protects your life, the want bucket protects your lifestyle, the aspiration bucket grows your legacy. Fund them in that order and only take real risk once the earlier bucket is secure or buckets are secure. So putting an aggressive sounding portfolio into near term need goal, because markets always recover in the long run. They do, but your goal date doesn't wait for the recovery. So basically, when you are getting closer to the goal, you need to shift out to more conservatively managed or a debt heavy allocation, even if you're an aggressive investor. So the second mistake I have found is being overly conservative in an aspiration bucket just out of habit, even though there's genuinely nothing to lose by taking on more risk there. For example, you're saving for your child's education, which happens 15 years from today, gives you enough time of recovery. You need not be playing very, very conservatively there, because otherwise the inflation will start eating into the returns. Treating risk profile as one number for the entire portfolio instead of applying it separately to each bucket. So next time someone asks you, what's your risk profile? Ask them back, risk profile for which bucket? That one question alone puts you ahead of most of the investors around. If this framework helped, subscribe. I break down frameworks like these every week to help you think about your money more clearly, not just more actively. See you in the next one. Thank you for watching.
This video is for educational purposes only. It is not investment advice or a recommendation to buy or sell any security. Nothing here is personalized, and investment advisory or research services are provided only under a signed client or subscriber agreement. Investments in securities are subject to market risk. SEBI registered and NISM certification do not guarantee performance or assured returns. This video does not constitute personalized investment advice. Please consult SEBI registered advisor before making financial decisions.